Welcome to This Explainer. Today, we're unpacking what feels like a genuine financial mystery. Is a 2.3% dip in NVIDIA's stock just a meaningless blip, or is it the very first clue in a massive macroeconomic shift? Let's jump right into the data. So look, when the world's most important AI company drops 2.3% in a single day, it immediately begs the question on every single investor's mind: is the IR trade finally breaking? For months now, artificial intelligence has basically been the unstoppable engine of the stock market. So when the undisputed heavyweight champion of that space stumbles, it makes headlines. But, taking that 2.3% number at face value, that doesn't really give us the whole story. Honestly, it barely scratches the surface. Because focusing only on NVIDIA, that's a classic red herring. While they fell 2.3%, the broader semiconductor ecosystem, which we track with the Philadelphia Semiconductor Index, bled so much worse, dropping a staggering 5%. And that difference is absolutely crucial. It tells us investors weren't just dumping NVIDIA because of some specific issue with their business. Actually, scratch that, it wasn't just dumping. They were aggressively, deliberately slashing their exposure across the entire semiconductor space. To really grasp the sheer scale of this move, you've got to look at the total carnage across the rest of the sector. Micron plummeted 7%, Western Digital dropped 7.4%, and Sandisk plunging 9% in a single day. I mean, that is a massive wake-up call. We also saw heavyweights like AMD fall over 4% and Broadcom drop over 3%. When a sector that has literally been the biggest winner of the AI infrastructure boom suddenly gets hit this hard all at once, it proves investors are reacting to something much, much bigger than just one company. Which brings us to our first real clue at this financial crime scene. These numbers show us that Wall Street isn't suddenly doubting the reality of artificial intelligence, right? Nobody is sitting there thinking AI is just a fad. Instead, they're questioning the massive premium they're paying for it. I mean, these semiconductor stocks have already experienced enormous, life-changing gains over the past year. Now, investors are staring at those sky-high valuations and asking, okay, just how long can this extraordinary growth actually continue? Section 1. The macro domino effect. To find the real culprit here, we actually have to look past the computer chips and zoom out to a classic, totally unavoidable macroeconomic chain reaction. It's like falling dominoes. It starts with geopolitical tension in the Middle East, right? Which pushes up the price of oil. Well, when oil rises, that threatens to push inflation higher. When inflation expectations rise, investors instantly start to worry that interest rates are going to have to stay higher for longer. That fear directly drives up bond yields. And finally, the last domino falls. When bond yields surge, it just crushes high-growth tech valuations. That's the macro domino effect in action, and it slammed right into the AI trade. The absolute most crucial point here is that the true trigger pulling the market down was interest rates. Both the 10-year and 30-year Treasury yields shot up, hitting multi-year highs we literally haven't seen since 2007. And why does this matter? Well, as this audience knows, tech stocks are valued on distant future profits. When incredibly safe, guaranteed government bonds start yielding this much, those distant tech profits suddenly look way less attractive. Why take the risk when you can get a guaranteed return? And this pressure, it wasn't isolated to just semiconductors. It weighed heavily on the broader market. But look at how the pain was distributed. The tech-heavy Nasdaq got dragged down 1.33%, while the S&P 500 declined just 0.69%. Meanwhile, the Dow Jones, which relies way less on high-growth tech, fell a tiny 0.22%. So yeah, technology was clearly the target here. But here is the fascinating part. Investors weren't just selling in a blind panic. While the information technology sector dropped nearly 2%, defensive sectors actually went up. Healthcare gained 1.6%, and consumer staples rose 1.1%. Big money was deliberately rotating out of high-valuation tech and hiding out in safer, everyday essentials. They were literally trading AI chips for toothpaste and bandages. It was a highly calculated shift, not some random market meltdown. Section 2. Is AI actually breaking? So with all that money moving around, we have to ask, is the underlying AI technology actually stalling out? Absolutely not. Just look at this number, $1.5 trillion. It's a staggering figure. Global cloud and AI infrastructure spending is expected to approach that massive $1.5 trillion mark by 2027. Companies are still pouring mountains of cash into data centers, computing power, all of it. The long-term physical demand for this stuff remains completely enormous. Because the underlying technology is booming, the core issue isn't about AI being a total bubble. It's simply a matter of sky-high expectations violently clashing with economic reality. The real question is this: can AI earnings grow fast enough to justify the massive expectations already baked into these stocks, especially when borrowing money is suddenly getting so much more expensive?
Section 3, 3 scenarios for AI.
Now, we aren't just flying blind here. Let's look at 3 distinct paths this could take. In the bull scenario, hyperscalers keep building data centers, demand stays super tight, and this whole drop is really just a healthy, temporary reset that shakes out the excess optimism. Then there's the base case. In this one, AI spending stays strong, but growth kind of normalizes. NVIDIA remains a powerhouse, sure, but the stock becomes much more volatile as investors just stop paying those extreme premiums. And finally, the bear case. What if AI spending actually slows down? What if chip supply catches up, earnings disappoint, and Treasury yields stay elevated? That combination, it would trigger a massive valuation crash across the entire tech sector. Which path we take entirely depends on those larger economic forces we just talked about.
So moving forward, watching the breadth of the sell-off is far more important than reacting to a single stock's daily dip. If you really want to understand where the tech market is heading, you need to keep a close eye on these 5 critical macro factors: interest rates, oil prices, inflation expectations, the actual hard dollar amount of AI spending, and of course, corporate earnings. When these 5 forces align in the wrong direction, high-growth tech stocks become incredibly vulnerable, no matter how amazing their products are.
Section 4, the ultimate earnings test. This brings us to the ultimate verdict, the exact thing that could determine the sector's short-term fate. Investors aren't just going to be looking at top-line revenue anymore. They need to see if those massive AI investments are actually translating into bottom-line profits. If NVIDIA's earnings keep accelerating even faster than their stock price, then hey, these valuations can actually become reasonable again, and this whole event was just a normal correction. But if that earnings momentum starts slowing down, right while bond yields remain stubbornly high, that normal correction could mutate into a massive test for the entire AI trade. Which leaves us with this vital final question to ponder. Can AI earnings truly outrun the massive expectations already priced into the market? It's the question that will absolutely define the next era of technology investing. Thanks so much for joining me on this explainer, and keep your eyes on the data.